Hi, everybody. Welcome back to Ox Talks. Appreciate each and every one of you tuning back in today to watch the show. Thank you for subscribing to the channel. Appreciate all of you continuing to leave comments, engage with one another. I do like to see that. Please hit the thumbs up notification and also the thumbs up and also the bell notifications. You're notified of new content as I release videos. I was notified, a friend of mine texted me today and said that he has repeatedly been unsubscribed from the channel. Almost on a daily basis, he'll have to go back on and hit the subscribe button. I don't know. I would ask that each of you check that. I do see the subscribers. Some days they'll tick down 4 or 5 or 6 subscribers. Maybe those are some folks that just don't want to watch the channel anymore. I'm totally understand that is reality. But do me a favor. This may be becoming a wider spread issue where you are being unsubscribed. Frankly, I didn't think that we had a big enough platform or reach just yet to be having that kind of problem, but I believe it's happening. I've also heard that, or read that, in some of the comments from several of you over the past numerous weeks. So please make sure you are subscribed. I hate to tell you to check it every day, but if you don't mind, I would appreciate it. And give me your feedback as well if you're seeing this happen. Because if I see it happening, I don't know, I'll try to see if I can address it through YouTube. With that being said, let's get into today's stories. And I titled the video, "The Great Consolidation is underway and unfolding," because I saw some stories today which I want to share with you about the banking crisis. It also deals with real estate. Yes, we talk about this almost every day now, but this thing is a powder keg. It is about to come unhinged, I believe, in the banking sector and in this commercial real estate sector. And this will impact all of us across the board. If you're in the stock market, it could vastly impact your investments and your positions in the stock market. If you're in the real estate market, even if you're not in office space or certain types of commercial real estate, there's a contagion effect when properties start failing, when the loans start defaulting. It's a domino effect and a contagion effect which will impact surrounding properties and also other categories of real estate as well. And I think it also could have an impact even on residential real estate, as these banks start to fail. The first story today, or the first bit of news, is again looking at New York Community Bank. It seems to me that they are next to go. The bank, the stock was down again today at close 22.78%. So that is it's a 60 or 65% drop in this stock in the last week. I read that it is the lowest share price for this stock since 1997. Likewise, the regional banking index continues to fall. It was down today, it's down 12% now over the past 5 days. And that's the regional banking ETF. So that's a melting pot, if you will, of the regional bank stocks, and that is not doing well. This is ominous. It's sending warning signs. And the article I saw, which I wanted to bring to your attention from CNN today, says Wall Street is worried about another regional banking crisis. So, when you start to see every day now mainstream news media outlets coming out and parading this stuff across the mainstream, everyone has to pay attention because it's in full view of what's going on now. It says, it's been nearly a year since the collapse of 3 U.S. regional lenders left financial institutions and regulators scrambling to prevent the spread of a banking crisis. It says today, investors are worried that they're back on familiar territory. But while the last crisis was all about interest rates, this one revolves around the $20 trillion commercial real estate market. And it says what's happening. After decades of growth bolstered by low interest rates and easy credit, commercial real estate has hit a wall. It says U.S. banks hold about $2.7 trillion in commercial real estate loans. The majority of that, about 80%, according to Goldman Sachs economists, is held by smaller regional banks, the ones that the U.S. government has not classified as too big to fail. And this will play into the next article and the reason why I have titled today's video, The Great Consolidation. It says much of that debt is about to mature, and in a troubled market, regional banks might have problems collecting on those loans. There's no might. They will have problems collecting on those loans. This is more than $2.2 trillion will come due between now and the end of 2027, according to data from data firm TREP. The article goes on and says some companies are even selling off their once valuable properties for bargain bin prices. The Canadian Public Pension Investment Board recently sold a 29% stake of an office block in Midtown Manhattan to Boston Properties for just $1. The pension fund had invested $71 million in the building. Wow, what a whack that pension fund hit, what a whack that fund took in terms of a loss of a major asset. And you wonder how many of these depreciating assets are buried in other pension funds here across the United States. We've already talked about the California Teachers Union pension. So, again, another sector that's going to be impacted as these commercial real estate prices continue to drop. And as these borrowers continue to simply walk away from the properties and let the loans go into default. This is the Financial Stability Oversight Council, of which Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and U.S. Securities and Exchange Commission Chair Gary Gensler, our members released a report last December that called commercial real estate as a major potential financial risk. As losses from a commercial real estate loan portfolio accumulate, they can spill over, into broader financial system. They wrote, sales of financially distressed properties can reduce market values of nearby properties, lead to a broader downward CRE valuation spiral, and even reduce municipalities' property tax revenues. So on the heels of a couple regional banks basically going down in flames in the last week or so, the regional bank index continuing to fall, Wall Street warning through CNN. We get an article today. This is the last article I'll share with you, and it's from Reuters. And it says, and this is why I sat back, taking this all in, seeing all the negative news about the regional banks, the ones that will be first to go to slaughter, so to speak, and they will fail. They will be allowed to fail. This article from Reuters says J.P. Morgan to open more than 500 new branches over the next 3 years. All we've been hearing about recently is bank closures, branches consolidating, and the reasoning behind it we've been given as well. People are doing more online banking. People don't need to have brick and mortar buildings to go into. The whole financial banking system has changed, and that's not what people are looking for, and therefore these banks are deciding to consolidate. Well, J.P. Morgan is opening up hundreds of more brick and mortar stores. So what does that tell you? What is that about? You have the major sector of the banks, or a major portion of banks, reducing their footprints across the country, yet you have one of the biggest, or the biggest U.S. bank now deciding it's going to open up hundreds of new locations across this country. And they'll explain in this article why. And it's exactly the opposite of what we've been being told for the past 6 months or 9 months or a year as to why the banks other banks, smaller banks, were closing branch locations. It says J.P. Chase said on Tuesday it was embarking on one of its most aggressive bank branch expansions in recent years, with plans to add more than 500 new U.S. locations by 2027 to broaden its footprint in areas where it is underrepresented. J.P. Morgan's aggressive expansion strategy comes as some other lenders have been shrinking their presence. The number of active branches in the United States totaled 690 after 123 closures and 80 openings in the month of October, according to S&P Market Intelligence. J.P. Morgan had the largest network at the end of 2023 with 4,897 branches. Rival Bank of America, which has also been adding new branches, had 3,845 at the end of December. It says, quote, "Our branch network is one of the key reasons that customer opens accounts with us, and it has helped us attract deposits," Roberts said. "We really view our branches as a storefront for the entire company, and it's another anchor. And it's an anchor for us to expand our relationship with customers as we aim to be their primary financial partner." So now we're being told that's actually the storefronts that the customers like, that they want to go in there and sit down with a banking representative and not be looking at a computer screen or doing online banking on their phone in lieu of these branch locations. So we have JP Morgan Chase expanding. They're going to become bigger. They're going to be stronger. And they're going to become even too, how I phrase this, even bigger to not fail. Does that make sense? Sorry, terrible wording there. Horrible. As a lawyer, I should be a little bit crisper with that thought process. But you know what I'm trying to say. You think they're too big to fail now? Wait till they get 500 branches bigger. So we have a sea change in the banking sector. So what are they trying to tell us? Are they trying to make it so that our options in banking with regard to who we bank with are more limited? And then all of a sudden, maybe you'll have broad sweeping regulations implemented by Chase relative to, limited acceptance of cash, cash withdrawals, things of that nature. I have a feeling that's where this is heading. And you guys can leave your comments below. Let me know what you think. I think it's very scary. Less options is less freedom, less choices, less flexibility. And now you're roped into a much grander scheme of control. So today, that's the biggest story I could share with you. I wouldn't have come out and continued to talk to you about the New York bank and the warnings of Wall Street about the commercial real estate sector failing and impacting these banks if it wasn't for the story about Chase expanding. I hope you found this useful. I hope it's food for thought for you. And how do you diversify yourself across several banking institutions if the number of banking institutions continue to decrease and the number of branch offices continue to decrease, except for maybe the top one or two, like Chase Bank, like Bank of America. So I hope it was helpful. Check that subscribe button for me, please. Appreciate you all continuing to watch. I did a half an hour treadmill today here at the office. Going to get a workout in about an hour. I would ask that each of you please do the same thing. Get your walking in steps. Do some cardio. We talk about strength training. Do some weights, sit-ups, push-ups, things of that nature to increase and to at least maintain muscle mass and muscle strength. You can't just do cardio. And the diet we talk about every day is a bigger component even than the exercise relative to an overall fitness regimen, weight loss, and leaning down. So thank you again, and I look forward to speaking to all of you tomorrow. Bye.